Welcome to the Tax Law Channel. I'm Scott Drake with my guest, the tax lawyer. He is principal at Wood LLP in San Francisco, Mr. Robert Wood. Today we're talking about a new voluntary relief program for worker status from the IRS. Rob, always good to see you. Welcome back.
Thanks, Scott. Good to be here.
And one thing I love, Rob, and I'm sure you know this about me, I love to talk about worker status. We're going to do that today. Voluntary is a word you don't hear related to the IRS often in good terms. Is this something good for businesses?
I think it is. I mean, I think there's sort of a divergence of opinion out there. You're right, voluntary is not a word that you associate with the IRS, although, I mean, most of our system is voluntary. It's a self-assessment system where you fill out tax returns, you file them, and even though nobody wants to be audited, audit rates are still pretty low. Certainly, lower than 5% of the returns get looked at. So most things are voluntary, but you're certainly right, Scott, that when you say voluntary, people, I guess, think of the offshore bank account voluntary disclosure program recently. This one, though, worker status, your favorite topic, is to voluntarily change from independent contractors to employees. So that's what the IRS is trying to get people to do.
Now, in order to be eligible for this program, you have to qualify in various ways. And again, this allows you to sort of reclassify independent contractors as employees prospectively, which is great, because they just sort of give you a fresh start, but you do have to qualify. Can you talk about how to be eligible?
Sure, and I mean, the eligibility criteria are pretty simple. Basically, it's important that you have issued a 1099 to everyone. So in other words, probably listeners will remember we've talked about Section 230. I keep using 230, which is the Treasury regulations. Section 530 relief. 530, which is the sort of get out of jail free card that you can bring up in an audit. One of the criteria there is you have to have issued 1099s, and so here one of the prime eligibility criteria is you've got to have issued 1099s. And another big one is you can't be under audit by the IRS. And interestingly, this I suppose shows more cross-fertilization these days with different agencies. You also can't be under audit by the Department of Labor. And if you have been under audit in the past, you must have done what the audit recommended. So those are the basic criteria. Again, fairly simple, but it's going to catch some people and make them ineligible.
And it's in your best interest because in the event you were caught, the liability could be severe. In this case, when you crunch the numbers, it looks like you're paying 10% of the employment tax liability.
Yeah, I mean, there's again been some confusion about this too. So as you say, I mean, the fundamental principle of this program is that you would voluntarily, use that word again, reclassify people going forward. And it doesn't have to be for all employees or all workers, I should say. It could be for a group. So if you have 1,000 independent contractors that do delivery driving, but only 50 of them are sort of full-time, or 50 of them do inner city or something. You'd have to be able to distinguish so that you're not sort of mixing different groups, because of course you can't generally have some people doing the same thing in the same way treated as employees, and some doing the same thing in the same way treated as contractors. So those kinds of distinctions need to still be to be made. But you could carve off, and I think this is one of the most interesting things about this program, you could carve off one group of your independent contractors and say, well, these people I'm going to prospectively treat as employees. So, I mean, in some ways you might say, well, geez, why is this a good deal? I mean, that's not relief, is it? And Scott, as you just said, I mean, there's a price tag, which is a small one, and there's some calculations in the IRS guidance about these, but basically you look at what you paid the workers that you're reclassifying. So in my example, the 50 drivers, let's say, what you paid them in the prior year, so the 12-month calendar year, and then you take, Scott, as you just said, 10% of the employment tax, not of the amount you paid. So I mean, it's a little confusing, but one thumbnail sketch, if you will, of how to get the number is 1% of what you paid them. So if you paid them, $100, 1% of $100 is $1. That would be your fee to the IRS. It can be on $1 million or $1.5 million. It can be very small. I mean, in the $10,000, $15,000, something in that neighborhood. So it's not a big deal. No IRS penalties, no interest. I mean, this is considered a tax. It's not a penalty. That matters to a lot of people. But I guess to sort of stand back and look at the forest, why would somebody do this? I think is a question that I'm getting a lot now, and one that I suspect viewers will voice. And the answer is, you might do it if you think you have a weak case for keeping the independent contractor classification for at least these workers, and you want security, because the key thing that you get with this is a guarantee from the IRS that they're not going to go back and audit you for the past. That's worth a lot, and they actually sign something called a closing agreement, which is a binding thing that, I mean, I've been a tax lawyer for 30 years. I haven't seen a lot of closing agreements. They are unusual in IRS practice. It is a final contract, if you will, saying we're not going to audit you. So it's a carrot and stick, I guess you could say, and the carrot is, look, you won't have to worry about this anymore, and we'll, assess this small amount of payment that you make prospectively. You'll treat them as employees, and we can guarantee we won't go back in the past. For a lot of people, it's the past that is the big concern, because that's where the potential, I guess, millions of dollars might be in terms of employment tax exposure.
And I guess in closing, it's safe to say that the IRS is spending a little more time scrutinizing businesses in order to find these kinds of things, because the revenue is something that the IRS would like to have.
Yeah, I know. I mentioned carrot. I suppose this is the stick. The counterpart to the carrot is that just as the IRS is using the word voluntary, Scott, as you say, and just as they're promising they won't audit the past if you partake of this deal, they're also releasing press statements talking about how they have new exchange of information agreement with the Department of Labor and with many states, and they're targeting certain industries, construction being one of them. So there's a lot more scrutiny. It's a lot more seamless. I mean, before we go, I got one sort of caution, if you will, is that we're only talking about the IRS here. And so, another set of concerns that I'm hearing from clients is, well, okay, this might be a pretty good deal in terms of my latent IRS exposure, but what's it going to do with the state of California or the state of Illinois or or somewhere else? What's it going to do with my claims that I may have from the workers themselves? And I think nobody knows the answer to these questions. What you need to do generally is sort of look at the complete picture of the business and how many workers there are, what the exposure is, and in what state they're operating, or states, sometimes it's many states, they're operating, to sort of assess whether it's an appropriate deal to do or not.
All right, Rob, appreciate your time. Thanks so much.
Thank you.
He is Rob Wood with Wood LLP in San Francisco, also known as the tax lawyer who writes regularly in Forbes and other publications. And thanks for watching the Tax Law Channel.